Hello and welcome to our new show, a brand new show on ET Now, the class of 21. Well, we're calling it the class of 21 because in last 18 months, a lot has changed for the entire Indian public space. New tech and new consumer tech companies have gone public. Same time last year, there was a tinge of a euphoria. Couple of months ago, there was a lot of fear, but now optimism, hope, reality is coming back for some of the consumer and fintech stocks. So to understand the way forward for PB Fintech, or popularly known as Policy Bazaar, it gives me great pleasure to bring on board Yashish Dahiya, the co-founder of PB Fintech or Policy Bazaar. PB Fintech or Policy Bazaar?
Whatever you want to call it, yeah. But PB Fintech is the legal name, yeah.
Same time last year when you went public, there was a little bit of euphoria. There was a tinge of excitement, and 4 weeks ago there was a lot of fear. But do you think now things are settled? Markets have understood the real growth and the terminology and the ideology of some of the consumer tech and fintech companies?
I don't know, I can't really comment on that. I think, no, not really, is my honest opinion. I'm not talking about share prices, etc. I'm just talking about the profit capability of these businesses. See, in the past, if you were putting up a steel plant, when you put up the steel plant, you would have capital expenditure, right? And then when the steel plant started operating, it would make profits. When you talk about these businesses, I'm not talking about these businesses, I'm talking about Policy Bazaar and PB Fintech. There's a huge investment in brand, in the platform, in the basic product, and that has flown through in the P&L. So what would otherwise have been capitalized? So what one is saying is actually there is no value to my brand. There is no value to being Policy Bazaar, to having this huge amount of direct traffic coming in, and for the platform to have been built. There is no value to that, is what one is saying, if one is only looking at the profit. Because what's happening is, what would typically be a capital expense is actually flowing through your P&L. So if you look at our depreciation, it's negligible. And so the interesting part is, once these turn profitable, your entire capitalization has already been paid for.
So true.
And from there onwards, essentially the return starts. And I think one gets the story, right? And I think that is the big piece that I think the markets have still not understood in great depth. That what does this mean 5 years out? What does this mean 7, 10 years out, as these brands start to become stronger and stronger?
You are new to Bombay, so you must try the vada pav here. I can, assure you the vada pav from this place. It is something which is really gives you the flavor of the Mumbai city. Have you liked vada pav in the past?
Of course I have.
Yeah. You've lived in Bombay?
I have lived in Bombay, lived and worked in Bombay.
Oh, okay.
For a company called IDW Signode back in 1998 to 2000.
Okay, so vada pav is not new to your palate?
No, not at all.
I can guarantee you this place in a sense as one of the most delicious vada pav. It's very close to our office, so it's always one of the places where we hop across to.
Okay.
Please try. In last 12, 18 months, again, the environment at a macro level has changed. Interest rates have
gone up, yeah.
It's not easy to raise cash now. The way growth companies are going to be valued, it's also very different.
Yes.
So what has been the realization for you per se?
See, my view is, and I remember this from a conversation well before I started Policy Bazaar. I was at one of these, and I think it was the guy who built games to win or something of that sort. And he was saying that, look, I have seen the cycles. There are cycles when markets go very buoyant, and there are cycles when markets go sort of very negative. So these are just cycles. Interest rates going up, interest rates going down, etc., etc. I don't know what the future holds. If somebody does, rather than telling the world, they should be taking advantage of it.
But your stake at the beginning of the IPO when you went public was 5%, it is still at 5%.
It's a little, my stake has increased and will hopefully increase further by about 1% since the point when we went public till now.
So why will your stake increase?
Because we had ESOPs, which when you get the ESOPs, you exercise them and your stake goes up. And when you exercise them, you also have to pay taxes.
Thank you.
So for that, you have to sell some shares. That is how it is for most people.
Has the public market forced you to rethink any of your strategies? The general mantra for a consumer tech or a fintech company was growth. And the more you grow, the more you are valued. That was the matrix which was used by PE investors.
Yeah.
But has the stock market or the public market compulsion forced you to rethink your growth strategy?
So one of my frustrations is that the public market will claim that it has forced us to rethink our strategy, while our strategy has not changed at all.
Or is it?
At all.
Okay.
It is exactly what we were going to do, is what we are doing. Nothing has changed. But my frustration is that we will not be given credit of that in the end, because the market will spin its own story. And so the market will, or the media will spin its own story. And the story that fits the narrative right now is that the public markets have forced the companies to go towards profits. We have done nothing new. Our business is exactly what it was. Nothing has changed.
But your expansion, maybe expenditure in terms of the new businesses which you are incubating, the employee hiring, all that has not changed because of public market compulsion.
Let me actually explain. It was after the focus on profitability in the public markets that we started a lot of our new initiatives.
Okay.
Which did not exist. So in 2021, we did not have anything called new initiatives. This year, I'll be making almost 250 crores of losses on new initiatives, which did not exist at the point of the public markets euphoria. So all I'm saying is, maybe we're different, maybe we're out of step with the market. Yes, our new initiative costs have been coming down, but that's exactly what was planned to happen, because they went up and they came down. It wasn't that we're doing anything different. And I think I would love for people to appreciate reality for what it is, rather than, spinning their own narratives and putting everybody in the same bucket.
SoftBank has sold half its stake.
Yes.
Tencent has about 9% stake.
About 5%.
About 5% stake.
Yes.
Okay, I stand corrected on that one. Are you getting a sense that more and more anchor investors are looking at reducing their stake?
I wouldn't have a clue.
So they did not approach you when they were selling in the public market?
I can tell you very candidly the conversation I had. I had a call with all the anchor investors 1 day or 2 days before the lockup. And I told them I'm very, very grateful for all your guys' support. The company is strong, does not need your support at all. Do whatever you have to. And don't at any point believe that you owe the company something. And for that you have to hold on or sell or whatever. Whatever else anybody tells you, I'm telling you this straight from my mouth. It was a 5 to 10 minute call and that was it. And I don't think I have spoken to any one of them. Don't know. I can confirm I have never spoken to any one of them about whether they are buying or selling or what they are doing. That's their choice.
You have 90% market share of the online market broadly.
Of the aggregator market or the distributor market.
Distributor market. Broadly 90%.
Yeah.
You're growing at 30%.
Our premium is growing at 70%, but yes, our new business is growing at 30%.
30%, right?
Yeah.
Which makes it almost 3x than that of the industry average.
Sure.
This business itself is a growing business and your core business is now making money. So what is the need for you to expand? And what is the need for you to incubate businesses which initially will be eating into capital?
We started the new initiatives because we thought it was very important to do those activities. We started the POSP business. It can give you very rapid scale. It helps our relationships with suppliers. See, insurance is not a mechanism by which you only do things one way. You can do the sales in multiple ways. And that helps you build your partnerships with suppliers because they are looking at the overall volume. So that was the primary reason. And it's a decent business. We think it's going to make good money in the future. But the scale advantage it gives you on your overall business is phenomenal.
Okay, I think I'm holding you back from
No.
enjoying the food. So I'm just going to nibble a bit here. As per the last reported data, and if I take the ESOP charges away, you're actually making money, which means there's no cash burn.
Yeah.
And you've given a guidance that you will be positive, which is profitable, in FY24.
Yes.
Define that for us. First half, second half, first quarter, second quarter.
No, full year. When we finish March 24, Because see, we are a seasonal business, so you have some seasonality, etc. When we finish March 24, overall for that thing, we would be PAT positive, is my estimate.
What could challenge your estimate?
Not too much. And I'll tell you why. See, in our first year, we had ESOP charges of about 700 crores. Those will be down to 300 automatically. So that is a delta. We have 5,000 crores of cash that generates interest income. We have a renewals business which generates about 300 crores of revenue. It should generate about 450 crores next year. So, and that is a very high margin business. So all of this put together pretty much guarantees it. See, if anybody noticed, last quarter we did make 87 crore loss, but our ESOP charges were 111 crores.
Over 100 crores.
Yeah. So the moment you take that out, from a cash perspective, we have been not burning cash for a while. Our cash balance was the same at IPO as it is today. And that's why I'm saying I think what I was trying to tell the market is that yes, you're seeing losses, but those losses are ESOP charges, which are an
That's
accounting...
not operating loss.
Which is an accounting charge, because the ESOP charges are for 5 years. You're giving the same amount of ESOP every year, but in the first year you're charging 700 crores, in the last year you're charging 40 crores. For the same amount of ESOP every year. So that is just a delta of 660 crores that comes just from the ESOP charges.
So when you say a number of 1,000 crore for FY27, how are you deriving at that number?
See, if anybody does the mathematics, our renewal revenue keeps growing. Our new initiative losses are coming down, and it is expected by 27 they would break even. So they'll be at zero. Our core business, is already positive. It's already made 100 crores of positive EBITDA this year. And the ESOP part is going to disappear, because that is a notional charge which you're seeing right now, but that will not be there after 5 years. You put all of that together, and there is no way you will come out with a different number. It's not my number or your number. It is about just understanding how the renewal, and please appreciate, I'm not even building business growth into it.
What is the business growth according to you?
Broadly about 30% on fresh business, roughly about double the rate of the industry is what I would say.
But if I speak to manufacturers, both private manufacturers and even LIC, they're not very happy about growth. In fact, all of them are still recovering from the COVID jhatka. They are, in a sense, clear that the long-term picture for insurance is great, but in the near term, maybe it's the pricing or maybe it's the growth base. They've gone through a rough patch. So if the manufacturers are complaining about the growth, why would a distributor be growing?
See, I'm not going to comment on manufacturers, etc., and what they, and I won't even know. See, I'm focused on a very, very basic problem. This is the middle class in India. Families earning between 5 lakh rupees to 25 lakh rupees have a lot of difficulty if they fall sick, or if the earning member dies or gets disabled.
You must try the Golgappas, yes sir.
Yeah.
Golgappas are...
So, very serious problem for which we don't have a mechanism. Earlier, the mechanism was the joint family system. But the joint family system is going away. And the same problem exists at the pension end also, which by the way is as big a problem. These problems, if you focus on them, the problems are there and you have to solve them. The solution comes from education, it comes from making sure the claim support is good, all those pieces, making sure you have a good platform where the consumers can transact. I think as long as you're focused on that, I don't think growth can elude you. I think as an industry, we do a lot of things, not just the protection element. And I think maybe that's why we sometimes have compulsions one way or the other.
Now, the minute I say policy bazaar, the recall is insurance and protection. But you also have a credit business, and that's a sizable business now.
Yes.
So that's one business where competition is only increasing.
Yes.
By existing players, by fintech, and what, in a sense, Reliance is planning to build. What will be a competitive edge in the credit business?
See, we're a marketplace.
Yes.
So, and this is why people misunderstand. A lot of people think direct players are competition to us. They're not competition. Almost more than half of our sales come from direct players. Because as a direct player, where do I get volume from? I can get it from Google, I can get it from brand, or I can get it from marketplaces like Policy Bazaar and Paisa Bazaar. Now, for the consumer, what's the benefit? He wants a loan. He doesn't care who gives it to him. He wants to know, I want 5 lakh rupee loans for the next 3 years. Who will offer it to me fastest? At what interest rate? And for that, he comes to Policy Bazaar, Paisa Bazaar. Paisa Bazaar gives him a choice out of 100 odd partners. That because every customer is a different segment. There's some people who are very well off. They will have pre-approved offers from the top banks. There are some people who cannot get a loan at all. And they would have, you are building a sustainable...
Some riders are there, yeah.
And no, you will almost have different kind of offers or very specialized lenders who would be lending to them. So building that entire marketplace and making it work in a commercially sensible way for the suppliers and for itself adds value to both the consumer and the suppliers. And so it has a place out there.
Because of each technology innovation, we've seen historically industries are getting challenged in terms of the total fee and the distribution structure.
Yeah.
Brokerage industry, zero brokerage, zero that came and disrupted the entire thing.
Yeah.
Mutual fund, direct versus distributor, direct industry is growing right now.
Yeah.
Now, the insurance industry is a fat margin industry. Can that get disrupted?
Of course. And why not? But right now, the cost of acquisition is very, very high. So I'll give you an example. If an insurance company tried to use, let's say, Google to acquire customers, its cost of acquisition is upwards of 100%.
Okay.
More than 100%.
For
More
the
than the
first
premium.
year.
More than the premium.
Okay.
Okay.
More than the premium.
More than the premium.
Okay.
I'm not talking about 100% of revenue.
Yeah.
So someone like a Policy Bazaar is operating at 17-18%. So even if you were to pay for 5 years, it will take 5 years. Plus, if you do an NPV, we are at a 20% IRR on the NPV front. There's a lot of value of acquiring business from Policy Bazaar, and your brand also gets built. So we are able to give good volume business to somebody with brand accretion, right? The second thing we're able to do is get good declarations, so that your claims ratios stay under control. As long as you can bring customers to the table, and you can get good quality business, which is the declarations part, you will largely stay, you'll be adding value to the insurance companies.
Fair point.
And as long as you're adding value, you have a play. The day an insurance company can actually acquire more efficiently than you, then yes, it should. Why not?
But you don't see that happening even with IRDA talking about a direct platform?
No, it will happen, and why not? And our own margins, we may see, take rates come down and all that stuff. I think that's just an evolution. All I have said is, all along, we are currently in the top decile of the most efficient ways to distribute insurance.
Okay.
If you're direct, you have to spend on Google, you have to put a call center. It is far more expensive than the Policy Bazaar mechanism, right? Some mechanisms do not allow you to have a good claims ratio. So when you look at the overall in a circumspect manner, it's a top decile area from an efficiency perspective. I think usually the bottom decile should worry, not the top decile. And there is no reason why the top decile will not keep getting more and more efficient. Now, a lot of people confuse this with mutual funds or something else. My humble opinion is, I think it's their, maybe they've not understood the industry enough. Out here, a customer does not buy. A customer has no gratification from buying an insurance policy. You buy a policy not to take a claim. You buy a policy to hope that in the case the worst happens, the claim is there. But you don't want to deal with the policy. Nobody wants to go to a hospital to make a claim.
Yes.
Right? So I think it's a very, it's a difficult industry, and I think people have understood. If they are thinking in a similar manner, they've understood very little about it. Motor insurance is a different ball game. That is direct. Motor insurance, two-wheeler insurance, travel insurance. Why? It has a date by which you need to purchase.
Yes.
In term insurance, you don't purchase. What's the problem? Not today, not 6 months, not 6 years. You may never purchase.
It is not a compulsion, which is what makes it very different.
There's no compulsion.
You're sitting on 5,000 crores of cash. Now that's about $750 million, depending on the dollar value we look at.
Yeah.
What is the need of such high cash? Some of your peers have announced a buyback. Would you consider thinking on those lines?
We have made no such decision so far. When we have a decision ever in the future, if we have, we will of course let the markets know, but there's no such decision
So
whatsoever.
5,000 crores is a lot of cash when you are confident that your businesses do not need capital to grow.
Let's see. I think we are at least till March 24. We want to just execute rather than focusing on other things. And I'm not saying it's bad to focus on other things. It's just we're not interested. We want to complete March 24, and maybe at March 24 reevaluate the situation.
You know, a lot of IT companies, for the longest time I have tracked them, let's say from 2000 to 2016, 17, they were sitting on a lot of cash, IT services. They called it strategic cash, and they never acquired anything large. So are you sitting on 5,000 crores strategic cash?
Nothing of that sort.
Nothing of that sort.
Nothing of that sort. See, we have had in the past marketing expenses, etc. We were in the past not making money. And now for the last 1.5 years, we're not losing money. And hopefully now we will start making money. So I think as we get into 23, 24, and the reason I mentioned that, I think there'll be a lot of positive cash inflow. See, we are on positive cash flow now. So I think next quarter you should see a lot more positive cash flow, and then next year, a lot big. My assessment is we should have about 400 crores of positive cash flow next year. So as that starts to happen, then people, then you do start to ask the question that if you're on 400 crores positive cash flow and have 5,000 crores lying around, then what are you doing? And I think that question will become very loud by March 24, which is why I said, let's rest till March 24. Today we still have different metrics, EBITDA, adjusted EBITDA, etc., etc. Let's get rid of all of this. Let's get to full PAT. Let's get to positive cash flows of at least 100 crores a quarter, 400 crores a year. And we are just 4-5 quarters away. So let's just deliver that. And once we've delivered that, then let's reassess what should be our capital strategy. I think it's not time for strategy right now, right? It's time for just. I think my biggest difficulty is I think the market has not understood who Policy Bazaar is.
Yeah. That's the reason why we're having this meal over the lunch.
Yeah, and I think
I'm stopping you back again.
No, I've eaten enough. I don't eat so much. But I think once we achieve that, then we can focus on a few other items. But I think right now that gap exists.
Is there a number you're chasing for Policy Bazaar and for yourself? Gordon Gekko in the movie Wall Street once famously said that every man on Wall Street has a number. So what is Mr. Dahiya's number?
1,000 crore PAT in 27.
Will that make you happy?
That's my goal. That's my stated objective. That as I look at the next 4 years, because we're at the end of 23 now, so 26, 27, that we should make 1,000 crore profit. I think it takes away the question that are you profitable? Is your business fundamentally profitable? That